Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas in 2024 and you're wondering, should I wait for interest rates to come down a little bit more or should I buy now? Is now the right time? Stick around. In this video, I'm going to teach you everything you need to know. So we all know interest rates are starting to trend down. That is a great step in the right direction. We have all been waiting on this. Lenders, potential homeowners, real estate agents, everybody that's in the space, especially here in Dallas, Texas. And so as interest rates are starting to decline, we are now in a predicament and starting to get in one, which is, hey, rates are trending down. It's in our favor. How far are they going to trend down? How long should I wait? And what's it going to do to the market? So I just want to go over a couple things today. For you as a potential homeowner as far as timing is concerned, because real estate's not always about waiting to buy. Real estate's more about buying to wait, meaning you buy the property when you need it, when you feel like you got a good deal at a good time, and you wait. And eventually over a long period of time, your house will appreciate, you'll make money on your house, you'll get to obviously pay your principal down, and you'll get some tax deductions. But the big question in 2024 is, when should I buy? You know, Brian, interest rates are continuing to trend down. I don't want to buy at 6.5%. I want to wait till 5. I don't want to wait till 5. I want to wait till 4. Well, those are all good thoughts if you're a payment-driven person, but I'm going to give you, in my opinion, what I think the secret is to buying in 2024, when you should buy, and as interest rates continue to drop, what it's going to do to the market. So the first thing that I want to talk about is declining interest rates. So as rates continue to decline through Q1 and Q2, what you're going to find is any potential home buyers out there that couldn't qualify because rates were too high, or maybe could qualify but they just didn't love where their monthly payment was at, they're going to start shifting forward off the sidelines. So if interest rates were at 7.99 at the end of 2023, they're probably somewhere around 6.99 right now. And so those people are reconsidering coming off the sidelines and starting to make offers on houses, because while 6.99 is not great, it's much better than 7.99. And a lot of people are thinking, okay, maybe now's my time. Let me get back in so I can get a cheaper rate, more affordable payment, but I don't want to wait until rates drop a ton more, because the problem with rates dropping a ton more, which I'm going to get into in topic 2 here in a second, is that it creates too much demand and a price spike. And then what you save in the rate and the payments, you overpay for the house, not only for the cost of it because it's going up, but also you get any seller concessions. So I think the ideal time to buy in 2024 is any time from probably January to May. I think you're probably going to see interest rates continue to trend down till probably March or April, and I think that's when we'll potentially get our first Fed cut. Now, it may come a little sooner, it may come a little later, but I think by the time we get to, again, late spring, early summer, you're going to see interest rates probably 0.5% better, and so that should be somewhere around the 6.5 range. That's great for a lot of folks, and I want people to take advantage of that. The lower the interest rates go, the more people will come off the sidelines. So if you can get your property anytime by May or get it under contract anytime by May, I think that's what I think the best of both worlds is, where you're going to get a house at a price that you probably like, an interest rate that's competitive, right? It's not as high as it was, it's not as low as it will be, but you don't want to wait to that low as it will be, and I'll talk about that here in a minute. But you got 2 competitive things: great house, great price, competitive interest rate with an okay payment, knowing that you're probably still going to refinance in 12 to 18 months, but you can take what you can get right now because it's not so competitive and you're comfortable with the terms and the payment, and maybe even be able to get some seller concessions on the price of that house, whether it be closing costs, whether it be repairs, whatever it is. I think that ideal time is through May. So that's part 1. Part 2 I want to talk about is declining interest rates, where they're supposed to bottom, and what this will do to the market on the bad side. So part 2 is declining interest rates, right? As interest rates continue to come down, as we head closer and closer to the election, more and more people are going to get excited about cheaper interest rates, because the simple, basic, elementary thought is cheaper interest rates equal cheaper payments. With affordability still being a struggle in the United States, especially on housing, people are single-minded on the rate and the payment. And why I understand that's super important, what you guys have to remember is as interest rates come down, more and more people have the same idea. Okay, I've been waiting on the sideline for a year. Back in 2023, interest rates were too high. I couldn't qualify, or if I could qualify, the payment was just too high and I couldn't afford it for myself or my family. So now that rates have come down from 8% to 7% to probably around 6.5%, people are starting to ease off the sideline. I always explain to people, do not let opportunity turn into greed. If we're down to 6.5, don't wait to 5.5, and I'm going to talk about that more in the second segment, because you have to remember, I give a dramatic example, but it'll set the stage for how to think when becoming a homeowner. Remember what happened during COVID. Interest rates dropped to 4.99, then they dropped to 3.99, then they dropped to 2.99. You had a ton of refinances out there, which is going to happen. There's going to be a refinance boom, so lenders are going to get full. But also there's going to be a purchase boom for all the people that couldn't afford it, or all the people that could afford it but didn't like the monthly payment. Now that rates have dropped back down somewhere in the mid-6s, they're going to go out and start buying houses with payments and rates that they can afford. But let's say you're on the other side of the coin. You're like, you know what? 6.5 isn't quite low enough for me. I'm going to wait till things get at least 6, maybe 5.99. That'll be my time. I understand the logic. I don't like the concept, and here's why. More and more people are going to come off the sideline as interest rates drop. So let me give you an example. If an interest rate is 6.5 and you don't love it and you want to wait till 5.99, that 5.99 to 6.5 difference, about 0.5% in the rate, on a $500,000 house, putting 20% down saves you about $180 a month. The challenge you're going to run into, in my opinion, is not the rate and the payment decrease. The challenge you're going to run into is 3 things. Number 1, price spike, which means where interest rates are at right now, you know, home prices are still fairly flat. There might be a couple multiple offers. There might be a couple soft spots in a neighborhood. You can still get the price at the house that you want with some concessions. But as rates drop and more buyers come off the sideline, demand and competition will spike really, really quickly. And what happens is there's not enough inventory out there to serve everybody. So you're going to see multiple offers again. You're going to see a house jump up from $500,000 to $550,000 to maybe even $560,000. And so for you as a consumer, if you're waiting till rates get to 5.5, all of a sudden the house you could have got for $500,000 is now $560,000. So what does that mean? Well, yes, your rate and payment may be a little bit cheaper, but you just paid another $50,000 for the house, which means that extra $50,000 that you paid on the house versus the 0.5% that you were waiting on, it probably ends up being about a wash on the overall bottom line, because you'll be buying more house that's more expensive and financing more money, so that offset and washes out some of the savings in the payment on the mortgage. While it still may save you a little bit, I prefer for you to buy when it's the $500,000 house at 6.5 or 6.6 or 6.7, pay a little higher payment, but as that house continues to push up in value, you're making a ton of money on the equity on the upswing, and you can refinance at the end of 24, at the beginning of 25, and rates are at the bottom, but you'll still make money on the appreciation for the house. The third piece about demand is just getting a house, and then if you get a house, having to deal with all the other people and having to do multiple offers and bids and paying over list price. So if you remember during COVID, when interest rates dropped and they kind of got to the bottom, which I believe the bottom's probably going to be the 4.5 to 4.99 range, somewhere in probably end of Q1, beginning of Q2 for 2025. You know, if a house is listed at $550 and there are 3 people that want to go after it, somebody's going to offer $555, somebody's going to offer $565, and somebody's going to offer $570, which means not only are they paying $50,000 more for that house that was $500,000 6 months ago, they are going to pay additional money above and beyond. So they'll do an appraisal waiver, which means they have to come out of pocket on their own money. If the house doesn't appraise because the demand is so high just to get it, you're not going to get any closing costs. This is another big piece I tell everybody. It's not what it cost you in the rate and the payment. It's what it cost you on the house. And outside of the price of the house, you have to think about the closing cost perspective. Right now, you're still able to sometimes get closing costs included in the contract based on the strategy and the offer that you and your realtor put together. So if you've got a $500,000 house and your closing costs are $10,000, if you can get that seller to pay that $10,000 for you, that's a lot of money. That's way more money than you would save in any rate and payment over a short period of time. Versus, hey, I'm going to buy the house at $560, I'm going to get a 5% interest rate, my payment's going to be cheaper, but I've got to overpay for the house for $10,000 out of my pocket on an appraisal waiver, which means if the appraisal comes in short, you're going to pay $10,000 in difference out of your own pocket. But as well as that being an additional out-of-pocket expense, what if you have to pay those $10,000 in closing costs as well? So all of a sudden, you've got a 4.99 rate, and you feel great about the rate, and you feel great about the payment, but the $500,000 house is now $550. You have to go $10,000 above the list price, and you have to do an appraisal waiver, which means, again, if it comes in low, you've got to pay that $10,000, which means you're on the hook for $10,000 out of pocket. Plus the $10,000 in closing costs that you could have got covered if you buy right now has to come out of your pocket as well. So that's a $20,000 out-of-pocket expense that you as the buyer end up having to pay because there's such demand on the property that you will have to absorb the additional $20,000 out of pocket when you go to buy the property because of the extreme demand. So you have to look at the totality of the transaction. You have to look at the specifics on the offer strategy. You got to look at timing. Again, timing is a crucial thing when it comes to buying a house, especially in a market that's heating up. It seems like every month or two or three, interest rates start to drop by 0.5% as we trend towards spring and late spring and summer, rates are going to continue to go down. And that's good, again, sometimes for the payment, but the offset is the demand, especially in Dallas with the lack of inventory and rates dropping, is going to spike quickly. And then you have so many people overpaying for houses, not getting closing costs, not even able to get themselves into a house in a place they like at a price that they like. And then as rates continue to decline in the back half of 24 heading into 2025, it's just a compound effect of how much more expensive it gets and how impossible it gets to potentially put your hands on a property. So I think that lowering interest rates is a good thing. I think it'll save people money in the payment, but I think the dark side and the downside to people waiting for interest rates to get lower is they have to understand the other side of the fence, the other side of the coin, which is what it does to the market. It pushes home prices up. It makes them more expensive. You can't get any closing costs or seller concession. You may miss out on multiple houses because there are other families bidding on it. You may have to go over and above the list price and pay out of pocket on cash. And so all these things end up costing the consumer more money overall versus if they just did it early, took a decent rate with a decent payment now and got a price that they liked on a house that they like, or maybe even some concessions. Remember, guys, you can always trade in the interest rate. You can't trade back the house. And sometimes timing and getting the best interest rate that you can at the time to get both a good price and a good concession on the house and a competitive interest rate, but they're both not at the lowest, benefits you in the long run because you don't have to deal with the chaos of what the market will be like when interest rates are lower and there's 5 times as many buyers coming off the sideline. It's a smart way to strategize. It's a great way to look. The last piece I'm going to add on this are loan product and loan program types. As the market increases and rates drop, not every offer is going to be accepted, even if it's a strong offer. Conventional loans and jumbo loans are the ones that are considered the most. So if you're a first-time home buyer out there, somebody that's looking to do minimal down, thin on cash, a VA buyer for our veterans, and even FHA buyers, when the market tends to be at its peak on competition, these sellers have 4, 5, 6 offers at one time. And so not only do they want the strongest offer from a number standpoint, they want to make sure that the mortgage officer that's helping the transaction, but also the type of pre-approval is taken into consideration, because people have a lot of fear around first-time buyers, buyers that are doing minimal down like 3%, FHA loans, VA loans. And so some of these people might be qualified right now and they're waiting for rates to drop. But the problem is when the demand goes up and these sellers start getting 4 and 5 offers on a property at the same time, if they have an FHA pre-approval or a VA pre-approval come across their desk, as demand goes up, they're less likely and less inclined to take those offers. So I want to make sure that everybody out there is aware of that, share that with your client, and make sure that everybody's fully set up for success when their time comes to make an offer in this 2024 market. So listen, I hope you found this video helpful. If you did, do me a favor, like, comment, subscribe, or even share it with somebody that you know that could benefit from this information. If you want to set up a conversation or have a mortgage planning session around your pre-approval, financial future, or the state of the housing market in Dallas, Texas in 2024, do me a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.